Right. So I think I would separate two types of treasury companies. One would be kind of the almost pure play treasury companies where their operations are tiny compared to their Bitcoin holdings and leverage on their Bitcoin versus a company that has a bunch of operations and then also happens to put Bitcoin on its balance sheet. In terms of the pure play, I do think that there's a limit to the long tail. Like I don't find the long tail very attractive either. I would kind of segment that by market, which is that you generally want to be one of the biggest ones in your currency jurisdiction, right? Because you're doing if you're in a non-dollar one, you're doing something unique relative to strategy. You're providing that to a different market.
One of the most important explanations lies in market positioning. Before the crisis began, gold had already experienced a strong 18-month rally. During that period, it attracted a significant amount of fast money, short-term, leveraged capital chasing momentum. When geopolitical shocks occur, these types of investors often unwind positions quickly, creating downward pressure through deleveraging and forced selling. Bitcoin, by contrast, entered the crisis from a very different position. It had already gone through a prolonged bear market, including multiple sharp drawdowns that flushed out speculative excess. By the time the crisis hit, much of the leveraged capital had already been eliminated. As a result, Bitcoin was largely held by strong hands, long-term investors with higher conviction and less sensitivity to short-term volatility. This difference in investor base created a key asymmetry. Gold was vulnerable to selling pressure, while Bitcoin was relatively stable.
Sometimes it's hard to say exactly what happened, but I would say that from my perspective, because people were surprised that, for example, from the start of the war, Bitcoin outperformed gold, which, if you polled people ahead of time, we have a Strait of Hormuz closure, a war with Iran, it's ongoing. Which one outperforms? The vast majority of people would probably say gold. I think a really big factor was that going into that, gold had a lot of fast money in it. It had a very good 18-month period. It was gold and silver were kind of going vertical, and they were correcting a little bit ahead of time, but in general there was still a lot of fast money in them. And whenever kind of war or unexpected things break out, there's often deleveraging. And just kind of a little bit of a liquidity squeeze here and there. Whereas Bitcoin by that point had already had kind of a kind of two-phase down bear market, had been kind of rolling over for months. And a lot of the fast money was already out. And a lot of the leverage was already kind of liquidated from some of those really big down moves that preceded it. So by the time the war breaks out, it's mostly held by really strong hands at that point. In addition, when we look at kind of, just global measures of liquidity, they're not amazing at the moment, but they're not as bad as you'd expect from almost 8 weeks of a Strait of Hormuz closure, an energy crisis, and war. They've actually kind of held up better than one might expect. And while it's not always the case, Bitcoin tends to correlate with liquidity pretty closely. At least it's one of the major input variables among a few others that tend to kind of correlate pretty well. And that's been holding up. So I think the combination of fast money is already out. It's already kind of washed out. And then we have, decent liquidity conditions. And then Strategy's been kind of tuning their stretch product. So they've been able to kind of raise. They had trouble buying much Bitcoin in the prior bear market. So for anyone kind of following that, they bought a lot in 2021, but they didn't really buy much in 2022. And it's not because they didn't want to. It's because they just didn't really have the mechanisms to do so. But they've been able to kind of tune the knobs differently this cycle. So they've actually been kind of more rapidly accumulating recently, which, all else being equal, does put some upward pressure on the price. Right. So I think I would separate two types of treasury companies. One would be kind of the almost pure play treasury companies where their operations are tiny compared to their Bitcoin holdings and leverage on their Bitcoin versus a company that has a bunch of operations and then also happens to put Bitcoin on its balance sheet. In terms of the pure play, I do think that there's a limit to the long tail. I don't find the long tail very attractive either. I would kind of segment that by market, which is that you generally want to be one of the biggest ones in your currency jurisdiction, right? Because you're doing, if you're in a non-dollar one, you're doing something unique relative to strategy. You're providing that to a different market, different currency that's being used as kind of the leverage for it. And there's really only, a handful of capital markets in the world that are kind of big and liquid enough to be interesting at this scale. but there's over a dozen of them, right? So if you say, okay, there's a dozen really liquid capital markets, and maybe you can have room for 2 or 3 in each one, that gives us a handful of dozens that might in theory be interesting. When you get outside of that, if you're like the sixth biggest one in your currency jurisdiction, the problem is that there are some liquidity network effects. It's kind of like how you can have 3 ETFs for something, 3 gold ETFs, but once you get into, like, if you're the sixth biggest gold ETF, you're likely not very liquid. And then liquidity gets even more important in the options market, because the options market is fragmented by the different durations and the different strike prices of options. So it's like a bunch of little mini markets. So you have to be really liquid in your underlying shares to also have a liquid options market, which Strategy does. And you have to have a certain amount of scale generally to issue preferred as your source of amplification. And so there is a situation where kind of being bigger is better. At least the biggest in your particular market, or one of the top 2 in your market. There's room for maybe differentiation of how much risk someone wants to take on. You can be, okay, we're the big blue chip with lower leverage and more liquidity, and okay, this other one is a little bit more of the wild card, the one that's a little bit more leveraged, the one that you bet on if you're a little bit more bullish on Bitcoin as kind of a trading vehicle. There's maybe room for that. I think beyond a certain point, that's where I go to kind of the second one I talked about, which is companies that do other things and happen to stack Bitcoin as well as a reserve asset. I think the runway for that is almost unlimited, which is to say, hey, we sell widgets, we sell industrial products, we produce electricity, we sell pharmaceuticals, we sell consumer product, food, for example. And we happen to stack Bitcoin as, maybe 10% of our assets, or 20% of our assets, or, we put 30% of our profits into Bitcoin, whatever the case may be. I think the recipe for that is huge over the course of 5-10 years. And so far, it's not a lot of companies have bit on that strategy. I agree with you. I mean, I don't want to put words in his mouth. It's been a little while since I saw that clip. But yeah, I would say that, one, I do think it's true that Bitcoin companies are not necessarily in competition. They can be, but they don't have to be, especially, again, if they're in different jurisdictions.
I agree on that.
And if they're in the same jurisdiction, I mean, it's certainly possible that they could target different risk audiences, for example, with their different security mixes or different strategies. Some of them might try to generate income on their Bitcoin by selling options or something like that, and that comes with different risks or different caps on prices and stuff. So I think there's some degree of room for differentiation. I just think that overall space does have a limit to it in terms of pure play treasury companies. But that more broadly, I mean, because especially from the beginning, like going back to like 2021, Strategy's been kind of an advocate for just companies in general putting Bitcoin on their balance sheets, and it's offered kind of the playbook on how to do that. And where I would certainly agree with them is I think the long-term opportunity for that is huge, because right now, if you're a company, holding cash is a liability over more than a certain amount, because you're just getting diluted over time, and so they end up decapitalizing themselves. They buy, they deplete their cash, they buy back their own shares, or they pay out dividends, which is all great. But if they purposely are doing that, and then they get hit with something unexpected, something. Maybe you're an airline and you get hit with a pandemic, or you're a tech company and you get hit with a major new competitor. You already decapitalized yourself, and so you have fewer options. And really, and they've all been punished for holding things. And you can only hold so many securities until you run into, you get treated more like an investment vehicle rather than a corporation. There's kind of limits on, that kind of thing. And so really Bitcoin is this kind of opportunity to hold a scarce liquid asset, at least alongside any other, it doesn't mean you can't also buy back shares or pay dividends or hold some cash, but it's a whole nother thing that they can choose to store up. I mean, it's volatile. So many companies won't put all of it in like a pure play would, but they can hold some aside and say, here's another lever that we have as a corporation to retain profits. And I think the runway for that is massive, even though I think it's slow to form.
Another major factor is global liquidity conditions, which Lyn Alden emphasizes as one of the most important drivers of Bitcoin's price. Bitcoin tends to correlate strongly with liquidity. When liquidity is abundant or stable, Bitcoin performs well. When liquidity tightens, especially abruptly, it tends to struggle. In this particular scenario, despite war and energy disruptions, liquidity conditions held up better than expected. There was no major spike in the US dollar index, which is often a signal of global dollar shortages and financial stress. This distinction is crucial. Not all crises are the same. Liquidity-negative crises, like early COVID-19, trigger forced selling across all assets, including Bitcoin. Liquidity-neutral or positive crises can actually support Bitcoin's price. In this case, the crisis did not produce widespread forced deleveraging. Without that pressure, Bitcoin was free to respond to other supportive factors.
I mean, a lot of retail investors are buying it, but also, many other types of just kind of pools of capital that say, okay, so I can get paid 11% with low volatility. So most kind of credit products, or in this case preferred, but it's kind of like credit-like, basically a yield product. If you get higher rates, usually one or two things is happening. One is you're taking on more credit risk. So you're buying like a junk-rated company, for example, or you're taking on a lot of duration risk. You're lending for 20 years, and so you're demanding a higher yield to do that. And that means you get a lot of volatility in the price of the underlying principal. Whereas this is kind of a unique one because you're taking very low duration risk. They're trying to factor out almost all the duration risk. And then two, you're over collateralized with assets. So it's a little bit different than a normal kind of junk rated company. And so you're not really taking on acute credit risk or duration risk. Instead, what you're taking on is Bitcoin risk. So it doesn't really work. If someone is like structurally bearish on Bitcoin, then their stretch preferred is unattractive because you're saying, okay, that's how someone will view it as like basically a Ponzi scheme. They'll say, well, Bitcoin is going to be flat to down, and they're paying out dividends from current expected issuance of their various securities. And so they'll say, okay, that's going to probably blow up in a couple years. But if someone is structurally bullish on Bitcoin, then they say, okay, well, here's a company that owns a lot of Bitcoin. It has a pretty moderate amount of leverage. The type of leverage they have can't be just liquidated. It's not really callable leverage. Instead, it's the type of leverage that you need kind of a slow motion train wreck for it to go bad. Like over time, if like the MNAV collapses to 1 or below, and kind of faith in the dividends of the various preferreds dries up, maybe because Bitcoin, let's say Bitcoin falls to 20,000 and they're no longer like say over collateralized. The market says, I don't really want to keep buying stretch. So it can certainly implode that way. But if someone is a bull on Bitcoin, they can say, well, I can own Bitcoin. That's actually what I recommend, is just own spot Bitcoin unlevered. But where their products come into play is that MicroStrategy is basically levered Bitcoin. So if someone has, say, a 12 to 24 month bullish view on Bitcoin, if you started at a reasonable MNAV, not like 3x, but like 1.2 or something, you're likely to outperform Bitcoin in a bull run. And then for the preferred, especially for stretch, it's saying, well, if you want to hold some cash for volatility reduction and buying dips and stuff, you can put some in stretch and earn a higher, twice the yield or more that you would earn on any other kind of like short duration thing, with the major caveat that there's a Bitcoin tail risk in there that's not there for T-bills, it's not there for money markets. But if for those that are Bitcoin bullish, it's kind of a near-term storage that pays better, and that they put up with the tail risk. I would be hesitant to talk about kind of a new narrative. I mean, it's one of those things like because it's a self-custodial, portable, liquid, money. It does have risk-off characteristics, but just because it's a 17-year-old technology, it's still not widely understood by traditional finance. It's still small in the grand scheme of things. Many large pools of capital still treat it as risk-off. There's a couple caveats around and I've had discussions with some institutions actually on this about why most crises Bitcoin tends to not do great for the next couple of weeks. It tends to be a risk-off asset, but a handful of crises it does well. And the kind of the main one they would point to is that regional bank crisis of spring 2023. And my kind of point there, again, comes down to liquidity, which is that there are certain types of crises that when they occur are very negative for liquidity. And you can see that, for example, in, say, the dollar index spiking. That's like a sign, especially when it happens very quickly, that there's a sign of global kind of dollar shortage. And so, I mean, a key example was really early in the COVID lockdown sell-off. You have the dollar spiking. Even the treasury market went illiquid. Stocks, precious metals, Bitcoin, everything straight down until basically hyper stimulus came in. Whereas when we had the spring 2023 regional bank crisis, it was actually like it was a pro liquidity crisis in the sense that as soon as it broke, all market participants understood that the Fed was going to basically come in that weekend, and that there's really there's a little bit of Bitcoin weakness in kind of the days or maybe the week leading up to that, and that's because that's actually when a little bit of the liquidity was happening, and then once it actually happened, there was ironically like a pro liquidity event. Basically, the entire market reset its expectations of what rates are going to be because they're like, oh, the Fed is kind of trapped now. They can't really continue being as hawkish as they were with this going on. So there was more dovish expectations immediately priced into the market. And they expected, and they were right, about getting very quick Fed and Treasury action. So that was ironically a pro-liquidity event. And normally, if you ask people, okay, we're going to attack Iran and close the Strait of Hormuz, most people would expect that's a negative liquidity event. And in past cycles, that possibly could have been the case. And this time it wasn't. There really was no spike in the dollar index. There's no major sign of dollar liquidity shortage of kind of the various indicators that I track. And so while there has been obviously some turbulence, the stock market went down for a little bit and it kind of rolled back up, even though the strait is still closed. Overall liquidity conditions are fine. There's not a lot of kind of forced selling. I guess that's kind of how I would describe a liquidity squeeze, that there's often forced selling. And usually Bitcoin does really bad in that environment, especially if it happens over a weekend, because if they expect that they're going to have to sell on Monday and you're a large pool of capital and you're kind of stuck, well, if you can short Bitcoin, you can sell any Bitcoin you have 24/7. So you can sell it on a Sunday evening if you want to or have to. And so I think it's often kind of like it kind of has the unfortunate role of like the biggest thing that trades 24/7, and that is perceived as risk off. But in some of these exceptions, it's because liquidity conditions kind of held up better than one might expect. So in a pro liquidity crisis, it actually does pretty well more often than not.
Alden also explores how Bitcoin is being integrated into more complex financial products. For example, some firms issue yield-generating instruments backed by Bitcoin. These products offer higher returns than traditional short-duration assets, but with a key trade-off: Bitcoin price risk. Unlike traditional credit products, where risk comes from default or duration, here the main exposure is to Bitcoin's volatility. This creates a clear divide among investors. Bitcoin skeptics view these structures as fragile or unsustainable. Bitcoin bulls see them as attractive opportunities to enhance returns. Importantly, Alden still emphasizes that for most investors, owning unleveraged Bitcoin directly is the simplest and most robust strategy.